Good morning. We are going to get a new area, a new series of webinars, which with some consideration, we have called it Mindset Meets Mechanics. And the series that we're going to be covering in this part, as I've said in the email, is portfolio consideration. So we're going to be talking about all things to do with portfolio management, all of the real world challenges and ups and downs that we face as fund managers, if you like, of our own money. And that's this one series, portfolio considerations. The other part of the Mindset Meets Mechanics series are going to be the updates, the actual market status updates, secular bull market updates and that. So those are going to comprise the two main areas, but there'll also be other training along the way that we do specifically with skills acquisition plans. So stay tuned for those as well. So today, in this series, the theme of portfolio considerations, we're going to use the public portfolios, the real world portfolios, as one of our members wrote to us recently and called them, and others have called them the same. So we're going to go with that terminology, real world portfolios, and we're going to use the public portfolios, three of them at this stage, the SPA 3 investor ones, which are real money portfolios, real world, real money, and we're going to use them as a basis for all the considerations that surround everything to do with managing your own money in the stock market. So that whilst there'll be the basis there, it's going to lead us into other areas of and hopefully raise questions and give a cue, if you like, to discuss all the other things that are to do with managing our own money in the stock market. And we'll focus in on obviously performance. We'll talk about stumbles and leaps and individual trades, and we can also do a Q&A session. So I'll try and keep it brief so that people who watch the recording don't have to put up with big chunks of time. Right, let's get before we get into that, have to, as we always do, say that everything we cover here is general and generic advice. There's no personal or direct investment advice that we provide in these, even though we'll be looking at the latest data. Right, to set the scene, I thought in this first one, I'd just talk very briefly about why I actively invest. Now, Dave, in the session that he did last week, he spoke about risk number 1 and risk number 2. Risk number 1 is really the risk of not generating enough wealth, if you like, enough money, growing your money, investing your money at a high enough rate to be able to have enough when you retire. That's effectively the biggest risk. So people who don't have enough and don't invest, are not taking any risk, and therefore not getting the returns that they need over the long term, because this is a very big picture long-term game we're playing, really, from when you first earn an income all the way until the last breath we take on the planet. So and that can be many, many decades. So that's the first risk. Second risk is what we talk about sequence of returns risk, and that is the order in which in your lifespan, if you like, the time, the period that the big market retracements happen. And so I'm going to put that into perspective today. And whilst those are the two big risks, the picture that plays off in my head all the time, this recursive loop that runs through my head, particularly when I get tested, I'm going to talk a little bit about that today. And it really is a combination of those two risks. And so what I have in my head is this picture, which I talk about in the secular bull market updates. That's the S&P 500 over since 1926, I think it is, or 27, 8, thereabouts, and coming up for nearly 100 years of data. And these secular bull and bear markets. Now, I'm not going to go into any detail about that now, but what I focus in on is not the secular bull market, it's the secular bear market. And that's really what I'm protecting myself. That's not only protecting, but looking to grow my money, my wealth in those periods. As Warren Buffett famously said, when he back in the 1950s or 60s, is that his aim is to match the market in bull markets and outperform it in bear markets. And his way of doing that is to have companies to spend all the hours and years and that he spent researching to find stocks that don't go down by as much. The way that I do that, and more people are doing these days, because when he came up with that aim, if you like, that objective back then, actively investing in liquidity was a very different world to what it is now, whereas now all of us can actively invest, and there's sufficient liquidity and tools at our disposal to be able to get out of the market altogether. So the idea is let's just focus on the last secular bear market and talk a little bit about that and how we can protect and grow, thrive, survive and thrive. And now, just looking at that period, you look at the bottom over here, you'll see that's the end of 1998, 97, 98, 99, going into the 2000 tech wreck. That was the growth going into that period, and that was an 88% growth running in. Obviously, the growth started a bit earlier, but just when we got into what we now know the benefit of hindsight was the big wide range trading market that it had. So it had that leg within the range trading market, 88%. Then it fell 49%, and then it went up. 100%, 103%, and then it fell by 56%, and then it rose to it's 133% from trough to peak. Now that's obviously trough to peaks, and it's this environment that I want to protect against. Whereas effectively, if you got an index ETF, which some people might have had then, or basically it started the SPY listed in, I think, 1993. So the idea of buying and holding an index ETF was certainly around then, and RJH started in 1995. So in the US, index ETFs were around, although relatively new, and I don't think many people would have cottoned on to the buy and hold through an index ETF at that stage. But if you had, your money would have effectively gone sideways. But you would have to have lived, if you could have, through the pain of two really big, massive drawdowns by buying and holding the index. Now, Dave also spoke last week about the core satellite, framework and how we divide that up. And I'm not going to go into that now. He did that then, and there's plenty of free material around on the on the internet that you can look up and get all the ins and outs about core satellite. And Dave covered that as well, and other training material has that. So in my investing environment, I've got all of my stock market facing money in Sponsoring Investor effectively, and I've got a little bit of trading money on the side. And the rest of my core, if you like, is not in stock market facing money. It's not in my illiquid money is elsewhere, but all my liquid money and wealth is sitting in the stock market. Why? Because I actively invest, and I actively invest because of this environment. This is the picture that's flowing through my head all the time, to protect and grow in this environment. Now, we may be, and I'll do a secular market bull market update in about a month's time, towards the end of August. But and we'll do an update then. But we are definitely closer to, although I don't know when it's going to happen. It may be imminent. I don't believe it's imminent from a technical perspective at this stage, but we're keeping an eye on all the technicals. But it could start any month, or it could start in 2027, 28. It could go the full 18 years from 2013, all the way to 2031. I don't know. But when I think we could safely say, being 11 and a half years into the secular bull market, that we probably closer to the end of it than to the beginning of it. And but when this secular bear market comes around, and it does look something like this, because all three haven't been exactly the same, and the next one won't be exactly the same as this, but I want to be able to protect and survive by being mostly in cash on the big down legs that come with the secular bear market, and be mostly invested in the big run-ups that we also have in the secular bear market. So this is the recursive loop that runs through my head all the time. Now, just as a way, without spending too much time on it now, if I just looked at the SPY, that's the SPX. The SPX is, and the timing signals we have now, it's a bit messy. It's a 20-year chart there. So, 1997 to 2013. Sorry, not quite, but there are timing signals on there that are that we use on the SPX, and there are also timing signals on the SPY. So just as a proxy to see how timing would have gone during that period of time, whereas effectively the market's gone sideways, let's just have a look at some statistics that come out of just trading the SPY. This is not a portfolio. I'll mention that in a moment. But so you would have done, by trading the SPY, let's just look down here first at the buy and hold annualized return. So that is buying and holding. This excludes dividends. SPY, you would have had a 0.75% return, and that little 0.75% was at the top right-hand side of the chart, where I effectively just took these dates, 1/1/2000 to 30th of June 2013. Now, the breakout happened at the time, and I wrote a lot about it, and even led up to February. Before that, in February 2013, I said there may be a historic event happening, and it happened in April 2013. Of course, I didn't know. I said May, and it continued to be the breakout that took us into the secular bull market. But during that period of time, market basically sideways, annualized return. But what did we get? We got a 6.3 annualized return with the by trading the SPY, both excluding dividends. Let's just have a look at some of the stats. Had a win rate, 52.38%. Average profit, you can see there were 21 trades over the 13 and a half years. And just look at some of the other risk managements. Maximum drawdown, minus 16% versus minus 56%. Expectancy obviously tells us we've got an edge, 1.53. Win rate, payoff ratio. But this is the other one that you want to look at, particularly when you're looking at indices, portfolios versus indices, is the risk to reward ratio. The risk to reward ratio, is effectively the annualized return divided by the maximum drawdown through the entire period. And then you just multiply by -1 to get it. So 6.3 divided by 16.07 is 2.55. If you do that on the index, you got a 0.75% return for taking a 56% maximum drawdown risk, and hence have a risk to reward ratio of 75. So this would give a return, certainly, but also be psychologically a lot easier to go through. And of course, you don't know what are going to happen in buy and hold with individual stocks. There are stocks in the US at the moment, like Cisco and a few others you can have a look at. Intel, I think, that still have not got to their January or March 2000 highs. And here we are a quarter of a century later, and they're still below those highs. So with stocks, you don't know what's going to happen, and hence that's why we trade as a portfolio. Just by way of interest, the other thing that you can have a look at here is the average loss trade was minus 2.95 versus 11.3 for the average winning trade, so 52% win rate, and you can just scan through and see what those trades were. Now you can do this in Beyond Charts yourself. You can go and set up a custom period, and you can then just take whatever period you like, and then just run these stats by going to the signal summary and looking at statistics and trades. So you can do all this yourself. Let's have a look at the All Ords now quickly. Similar sort of thing, exactly the same period. So I choose the custom period in Beyond Charts, has exactly the same start day, end date. And I've just put a relative strength chart over here to show that during this period here, from 2000 through to 2007, most of the time, the All Ords actually outperformed certainly the NASDAQ, because the NASDAQ really had an 82% fall in that 2000 to 2002 period. The NASDAQ 100, that is. The NASDAQ composite was only 72%. But the S&P 500 was outperformed by the All Ords, and then it underperformed it after that, coming out of in the second half of that secular bear market. So how did this turn out? So I haven't used STW, the ASX 200 ETF, index ETF, because it only started in April 2000. There was a bit of a lag and all that sort of thing, so it doesn't quite match up. So I've used the index. I've used the All Ords. And you can see a similar sort of thing here, 66% win rate. The risk to reward ratio, 1.7 versus 17, minus 12 maximum drawdown versus minus 54, 55%. And you got a return, 7.48. But look over here, the All Ords did a bit better because it ended up a bit higher, 3.2, so double. But the point I'm trying to make here is that it would be far easier to time and beat the market, if you like, through going into cash during the down periods in a secular bear market than a secular bull market. And that is when active investing really comes into its own. And there's the All Ords. Now, those the particular trades, and you see the average loss trade, minus 2.77, average profit trade, 7.45. So that is why I actively invest. And it's that recursive loop, not of making money and shooting the lights out, It's a risk management recursive loop that I have running in my head, and that is to strive to first of all survive and thrive during secular bear markets, because they're the toughest to get through over that long period of time where the market effectively makes hardly any headway. So what we're going to do now is look at some real world portfolios in Australia and the US. As I've mentioned, these are the public portfolios. The other point to make about that period is that you can run simulations with Sparse Investor over that period, and what you'll find is there's definitely an edge, but it's because we've got stocks in our universe now that were smaller stocks then. They were certainly liquid enough in the US market. They were 3, 4, 5, 6, 7, $10 million turnover a day, but they were relatively new at the time. So they had some really big up and down trends. And of course, being a trend following methodology, Sparse Investor really shot the lights out with those big uptrends. So it's a little bit unrealistic to go and run those now. But I can assure you that during the down periods, you were out of those stocks and you had an equity curve that went basically sideways to minus 15, 20% drawdown as opposed to the minus 50% drawdown, and would be far easier to get through, and you would make headway in an environment where the cash index basically went sideways. So let's have a look at the real world portfolios. In these sessions, I'm going to look at all three. Today, we'll have we'll probably do a little bit more than what we would typically do. And over these sessions, we might just pick on one and hone in on some particular things. But today, we'll just quickly have a look at all three to set the scene. Yes, I'll do the leveraged as well. That does come into quite a lot. It does influence what I do with respect to research and trade and execution. So we will cover it in these. What are the objectives of having these real-world portfolios? Well, certainly from a training perspective, they're an example, but it really are—they're examples of warts and all happenings and occurrings and challenges and ups and downs in real-world conditions. It's we're trading the right-hand side of the chart, and as you all know, it's real money and it's executed there and then. And I believe over the 8.5 years I've been running these two, I have made literally, from a timing perspective, missing a day here or doing an intraday because of time, or not doing a market on close, or vice versa. You could count them on definitely both hands and maybe even one hand. So those timing mistakes, there's hardly anything there. But we have made some other mistakes, and that is why, and I'll talk about those in a moment. So the objectives aren't just from a timing perspective on the edge of Sparse Investor. It's also mindset and money management as well. So timing, it's not just timing. When people talk about trading the market and being a trader, it's not just timing. Money management plays a massive role, and as you know from the 4-week trading intensive, mindset plays an even bigger role. So these come into what we've delved with in the last 8 years, and in particular, the money management issue, the money management part of trading, if you like, I'll talk to in a moment with the US portfolio. But the main thing is that these warts and all real world portfolios are executing under pressure with money at stake, and the market happens on a day by day basis. And when you're called to execute, you have to execute. So these are examples of doing that, and they test me as well. I'm a human being, and certainly there've been some decisions to make along the way. That I'll talk about in a moment. But before we do that, let's just talk about the recent market conditions that we've looked at. And this is the S&P 500, and I'll just do a snapshot over here of, if you just look at the shape of the chart, if you like, just get an eyeball mark too, and note that from the peak there in end of 21, beginning of 22. What is that? That's December 2021. It's risen 14%, just over 14%. If we have a look at the ASX from that same peak, maybe a couple of days later to current, risen 3%, just over 3%, 3.5%. So very different market conditions. Also, look at the middle over here. Very messy. It's kind of coming from this last trough, rising. If you have a look at the S&P 500, a bit more of a smoother, less choppy, more defined downtrend retracement here, and certainly a more defined uptrend over there. So the market conditions in the US have been different in Australia. And, we could go to a bunch of reasons. They've got tech stocks, biotech stocks, AI stocks, all that sort of stuff, very highly liquid, massive stocks that are huge market capitalization stocks that are different, which we don't have in this market. So, but we're not looking to reasons because, we have stuff as well that they don't have, in small to mid cap miners. And if you looked at that previous chart of the ASX from 2002 through to 2006-7, the major difference in that was that we had a whole lot of mid and small cap stocks that became, much larger cap stocks for a period of time, highly liquid and massively traded in that run up to the end of 2007, which is different to the US market, and in fact looked more like the NASDAQ composite, and in fact matched the NASDAQ composite in that period of time. So there are differences, and we just don't know when those differences are going to come to the fore. Nobody knows, and also when they're going to fall as well. And nobody can predict that, and nor do we want to, as we spoke about in the 4-week training intensive. But so yeah, we have two markets that have been pretty different, just to set the scene. So let's look at portfolio performance. We'll go into that, then we'll have a look at some stumbles and leaps, and we'll finish with a quote and talk a little bit about that. So this portfolio performance now for the two unleveraged portfolios, ASX and US, we've got 8.5 years of real world execution. And just to put into perspective as well, just to remind everybody that when we're going into this, that we did a re-optimization of the SPA3 investor parameters. We started that project about June 2022 when we realized that we just hit a new maximum drawdown, and so that set us off to go and do some research, and it was due anyway to do the re-optimization of the parameters. We went through that, and they were released, I think, in April, May of 2023, so just about 15 months ago. And just talking about also what's happened in that period of time, the ASX portfolio has kind of run right through. It did start off with a few with less open positions, and then grew to 9 as we released more stocks, or as we increased the size of the universes of the two of both US and ASX. But in the ASX, if I look back now with the benefit of hindsight, there were a couple of mistakes that we made, and they were money management mistakes. They were not timing mistakes. And the first money management mistake we had is that we were getting a lot of questions about what do you do with additional money if you want to add it to SPA3 investor. Do you put it into the same portfolio and increase the position sizes, or do you start a second portfolio? So we did a little bit of analysis and discussion, and we decided we'll start a second US portfolio, and we would, and this is the mistake we made, is that we would, as the stocks, the signals came up, we would make the two portfolios mutually exclusive, which meant that there were stocks that we didn't get into in the primary, the portfolio we have now, the primary number one, we called it at the time, the first US portfolio, if we already had an open position in the second portfolio. Now, at the time, we were also using BAP, so it is quite possible, to get into a stock, and then another signal occur, if you like, down the track, because you now had a BAP. And so you got an entry on the one, you got a BAP on the other, and we didn't take the BAP in the second one because there's already an open position in the second portfolio. So the portfolio one, if you like, didn't get traded with every signal as it came up when there was vacant capital. And with having done some research on that now, that definitely was a little bit of a handbrake on the portfolio that we're going to look at the results of in a moment. And so we decided to stop the second portfolio and just to put everything into one. And really the learning that's come out of that is that if you have additional capital to that you want to add, it's actually better to increase your position sizes and then to get that money into the market as soon as you possibly can. And talking about that, and then the question then comes up, do you pyramid existing open positions? Now, we're not going to go into this right now. Or do you wait for the trades that are open and then add capital? Now, that's a money management issue. That's not a timing. That's not an edge issue. That is a money management issue. And money management, timing, if you like, and risk management, the three components all make up how to manage a portfolio. And we've got to have answers in our investment plans for all three of those areas. The timing, so what is your universe and when do you time? So what is your actual timing system? That's number one. Number two is risk management, and number three is money management, position sizing. So that was really a mistake, and it went on for well over a year. The second one was when we did the money management, we reduced the number of positions as a result of research from 13 to 10. And the mistake we made then, we'll have a look at this in a moment with one of the trades that stayed open through that entire period, is that we ended up having too little in the market. Our exposure went down for too long. That is because we ended up with a couple of trades, and one in particular that carried on going, and we only closed it last week. And it effectively stayed open for about 21 odd months. And because the position size was done based on 13 open positions rather than 10, it had too little in the market. And we ended up having a massive profit trade on too small a position. So that's how those two have definitely had probably 10 to 15 to maybe $20,000 effect of lost profit on the US portfolio. But we learn from it. So those are two mistakes, and I should tell you that up front. And when we look at the execution that's going on in these portfolios, so I'm going to now swap over into Beyond Chart. So I'm going to try in these sessions, rather than present only in PowerPoint, I'll actually flick over and we will do it real life. So I'm going to look at 135 and Inception metrics for the portfolios. And what I'm going to do here, because the writing's a little tiny, so I'm going to put on my specs. So let's just have a look at the Australian, the ASX. What I'm going to do here is go into statistics, and we're going to pick the date. So we're on the 30th of the 7th. So I'm going to go back. Very simple to do this. Now you can see since inception, which we'll do first. It's got down to 2.1 for outperformance of the ASX 200 accumulation index. Now that has been much higher than that, and we'll see. Look at recent performance, and we'll obviously explain that, if you like, coming back a bit. But when the investment plan we have is to be 4% compounded, outperforming the ASX 200, and also the same on the US market. Now the minimum I want to put on that is 2, because over the long term, a 2% outperformance is going to, so it's the range of 2 to 5 is what we talk about in our documentation and have for many years, and but we've aimed at 4. So we are below, and we're also setting quite a high benchmark on we were measuring ourselves against the ASX 200 accumulation index, where most if you look at other funds, super funds and other funds alike, they are looking to beat the money market plus a certain amount, and that money market plus certain amount is always less than the ASX accumulation index. So we've set quite a high benchmark, and that's good. We want to do that because we want to challenge ourselves. And most other, in fact, all other, I haven't found any fund option or financial planner or anybody asset manager that says you should give it a go with them for less than 7 years. They all are a minimum of 7 years. So then we'll be going 8 years, and we've you look at, sure, we've underperformed. We were outperforming. We've underperformed our target, our goal. But that doesn't mean that it's this is not the end. This is an infinite game. This continues, and you can plot annualized return. You can see it's got as much as 6 or 7% annualized higher, and now it's come back to 2, and that's going to ebb and flow. It's not a dead set thing that's going to stay exactly the same all the time. As the market and the system and everything unfolds, the ebb and flow of the markets, in this infinite game we call trading. So now I'm going to go back to 37, and we're going to go 2023. So warts and all, over the last year, this portfolio has definitely underperformed. What are some of the stats we've had? Our exposure's up, our win rate is down. We've got a payoff ratio that's only just better than 1. So 1 equals 1 is, anything less than 1 is obviously not good. Expectancy has been negative, obviously, because of the minus 2.5%. Maximum drawdown hasn't been that high, a little bit higher than the index. And so that's obviously not been a good period. Now, that happens. There's no doubt about it. In the same way as we had brilliant outperforming periods, we're going to have some periods that test us. So now let's just go back to 2021. We'll do 1, so that's 3. And you can see over this period of time, also negatives has definitely not been a good 3 years. It's been testing. It's been a struggle, there's no doubt. But if we go back to the two charts where we compared the US and the Australian market has been much, much choppier. So has definitely not been trend following conditions. That is for sure. Some people might say, and I know we've had people run off and try mean reversion systems. Mean reversion systems might have done well. I don't know, because there have been, I don't know if the trends have been, it's been quite a wide ranging market now over these last three and a half years. Does that mean that the range trading that mean reversion will definitely work in that environment? I don't know. But what I do know is that in large trending up and down markets, like you have in a secular bear market, these mean reversion systems do not work. They tend to work far better in narrow ranging markets. So it's been tough. So what is the solution? Well, the solution is core satellite. Core satellite helps definitely in range trading, choppy markets like we've had in Australia, where you've got money sitting in index ETFs, and they would have done reasonably well, basically through dividends mainly only. And you've also got the option to have other satellites, and that is where, in the feedback I've had with customers, I've been doing interviews over the last 2 or 3 months, is another satellite is the US market. And the US market, their portfolios have done well, as we'll see in a moment. And I happen to be more weighted personally towards US. So overall, and that's certainly lessened the load on what's happening in the Australian market with this portfolio, because this is obviously my money. And just also to talk on this, I have other personal portfolios, one other where I've got a substantial amount of money in, and it's worthy of looking at the results and large position sizes, where I've got 7 open positions. Now that just happens to have be in the green and has got better stats than this one with 9 positions. And obviously the total mix of stocks has been different. It's taking a bit more risk because there's larger position sizes and with fewer. So, and I'm sure others of you would have had similar experiences. So whilst we're looking at one portfolio equity curve here on the ASX public portfolio, it should not be taken as the one and only proxy of all SPA 3 investor portfolios out there. But it's one that we trade, warts and all, out for everybody to see. Now let's just go back to 5 years, so 2019. And so there we're slightly ahead, only 0.5%, but that's starting to get better. We had a really good run up in the whole of 2019. Here we're looking at the beginning of 2019. So let's just have a look, just so you can see how statistics and that are very different. There we go, up to nearly 3 compounded percent difference. And we looked at the inception. So where you start and where you end makes a difference. Now I haven't looked at charts. I've just pulled that out. So that is the ASX. Has recent performance been great? No, it hasn't. I do know that we are setting a high benchmark. And I know of people that are trading subjective portfolio, because they've told me subjective portfolios, discretionary portfolios, who have done way worse than that, way worse. So we're holding our head. We're struggling through this period. We're holding our head, just slightly above or below water, and we are paddling like mad in underwater. So we're underwater in an underwater curve. So let's just have a look at some of the portfolio equity curve. That's the portfolio equity curve from inception. What this one does is it looks at the ASX 200, the red one. So this is our portfolio here. This is the real money portfolio here. And this, the black one, which I also plot, which is the All Ords, or the All Ords. You could do the XJO over here. I just chose the All Ords. Either will be the same. But I just do this here to just get a differentiation on difference between accumulation and cash index, because the accumulation index with dividends doesn't give you a realistic eyeball view of market conditions, and you can see there is a difference. And obviously it's dividends, but this is the price action that we are trading, and the timing is happening on raw price action without dividends. So I do that just to give me an idea of market conditions. So the periods that obviously my eyeballs zone in on are the periods where our portfolio has dropped, where the market's gone. It's probably risen slightly, but it's more or less sideways. The ones I really get worried about is when the market rises and our portfolio goes down, and that's when you're really out of sync. And that I know that's going to happen. And those are the ones that spark questions, curiosity, and what should we research without becoming knee-jerk reactive to individual small sample situations. But that's an equity curve I do look at. The other thing just to point out here is the number of open trades. You can see how they increased over time, and this is where we went into cash. That is in the COVID crash, into cash quickly, and you can see there's periods over here. The real high growth periods. It's just flat on 9 positions. Whereas look how jittery it's been just in this period over here, from really just because of the range trading market. Okay, that's enough on that on the Australian. Let's go to US and look at statistics. We're going to do the same thing here. We're going to that's inception. So we've got about 1.45% underperformance. And right, let's just go to 37/2023 and see how we've done. So about 1.4% underperformance annualized on an annual basis against the S&P 500. S&P 500's really done well. Statistics, 75% win rate, payoff 1.93. They would have expected 1.93, a little bit higher, expectancy 0.9. These are all good statistics. Let's go back to 2021. 3 ASX. So underperformance there. That includes the 2022 period where we struggled a little bit. We'll look at that in a chart in a moment. 2019 and just 0.3% compounded worse there. Now we also know that that if we look at S&P 500, we've got I think it's 93% of funds underperform the S&P 500. So it's been a strong performer. And in fact, over a lot of this period as well, there's been big chunks of time where Warren Buffett's even underperformed the S&P 500. So it's been a great performing system. And I'll call the S&P 500 a system because that's what it is. It's a mechanical system. And you can look up and see the rules all fit into 4 pages, and you can download those and have a look at them. And it's a mechanical system in its own right. So what we want to do is outperform it, obviously. And we've looked at we've done 5 years, so we've got inception there. Let's have a look at the chart. So one that I keep an eye on just for recent times is I've got the blue is the equity curve of the Aspire 3 Investor equity curve. The red is the S&P 500 total return index. The pink is the Nasdaq composite, and the green dotted is the Nasdaq 100 composite. So over this period, and this goes from September 2022, so we're a month or so, about a couple of months off it being two full years. So in an environment where, and I've had people I've spoken to, they show me that their equity curves in the US, and they're everywhere, right, using their own discretion. Now I don't know what's going to happen in the future, but I do know that I've got a system here that's going to keep me out of the big bears in a secular bear market, and it's going to engage me in the market in the big rising legs of a secular bear market. So that's really what I'm protecting against. What I want to do, that's the recursive loop I have in my head. But what I want to do is in these periods when it's rising, I want to at least match and sometimes outperform, and like Warren Buffett said, and really outperform in the bear markets. That's what we want to do. So that's and we'll just, what are others I've got over here now? I'm going to so that's inception. So inception is blue is the Aspire 3 Investor portfolio. Red is the S&P 500. So there was a period where we outperformed rising, and there's a period where we underperformed. These are the periods we want to fix. We want to do better. That's when we went and re-researched the parameters. And I'll talk to you about research in a moment as to some ideas we got to make this better. So that's where we go and do when you think of in terms of process and mindset, that's where we go and work on our process, and in particular, timing And this is not necessarily going to be, in fact, it won't be timing on individual stocks. It's going to be timing on the overall portfolio, which is risk management. So I'll talk a bit about that in a moment. Right, that's enough on the US. Let's just quickly have a look at the leverage portfolio statistics. That's overall. We started this in May 2018. It was a tough time, straight into a bear market. But let's just go back and look at the last year, 2000 and whoops. Do that again, 2023. And this portfolio has done very well on the back of leverage, right? So let's look at maximum drawdown first before we look at return. Minus 29%, say 30%, 29.5 versus 9.94 in the market. So there's about 3 times more deeper. You're looking at the equity curve of maximum drawdown compared to the index. But we've made $21,000 absolute profit. And that's more than double. It's 2.5 times annualized return. 53 trades. We've got 15 open positions in this. And the portfolio risk reward, this is where we're putting into perspective that 53% annualized return versus the 29% maximum drawdown. That is 0.55, meaning that the maximum drawdown has been just nearly slightly more than half of the annualized return. And the index is about the same, 0.5. So the index has had 20% return versus 10% drawdown multiplied by -1 to get the -0.5. So roughly matching, but obviously with the leverage getting a better return. Let's go back and look at in fact, what we'll do this one is, because we haven't got 8 years, we'll look at the last 2 years and the last 3 years. We've already looked at inception. And so the last 2 years, we got 10% compounded more, and minus 58% drawdown versus minus 16% drawdown. And portfolio risk to reward, we want to get that around about 1 or just under 1 if possible, between just under 1 and 1.5. So it's a bit higher, and you're going to expect that with a leveraged environment. Looking at equity curves. So this, I'll zoom out in a moment, but this has been the return since September 2022. It's that one there. And 282% rise, 110% growth in portfolio. This is from the trough. Obviously, we were trading it at the time. We didn't just start then, versus the S&P 500 total return index rising 62% in that period of time. So very different markets. This is the entire equity curve of the SPA3 leveraged portfolio. This is during this time, and I say that as an unrealistic time. I'm leaving it there for all to see, warts and all. But at this stage, we were trading on 10% margin. And then who we were trading with changed to 20% margin. There were some rules that were brought in by ACT that stopped 10% margin trading on stocks. And we had this fantastic run up here. This was mostly in 20% margin environment. And this is what we got to protect against. This is what we want to research. So I'll just put this up here now. And this is one of the things we're working on, which is a SPA3 index, where effectively you're in and then you're out during these times. Now, it doesn't look this clean because there's a whole bunch of other things that happen with stopping a portfolio and starting it again. So it's not as clean as this. But this is just just to give you an idea of what it is that we want to work on to improve what we call portfolio level risk management. Okay, I'll swap back into, just in the interest of time, I'll just get back into the PowerPoint slide, and we might come back into Beyond Chart. So we went through the equity curves, and we spoke about the market environment, a much choppier market environment in Australia, which has meant that trend following has been difficult. Fully accept that. What should I do? Should I go and modify what some people will do is they'll go and take that environment, they'll take their system and they'll try and optimize it for that environment. It's 3 years. I say, oh, gee, that's not too bad. I've got 3 years worth of data. I'll go and optimize it. Whereas that doesn't work. You've got to optimize it for the whole period of time, warts and all, ups and downs, trending, range trading. And then you get parameters out of that, which is effectively what we've done. And those parameters from a timing perspective are what you got to trust and trade. And of course, and just with all the mindset training we did in the 4-week training intensive is that, and the presentation I did a month ago, is that you can't prove the future. And what a lot of people do is they set out trying to prove the future based on numbers, when we know that every moment in the market going forward is unique. And at the same time as the way the portfolio got massively in and out of sync in a positive sense in 2019, 2020, we had massive returns relative to the market, in the Australian market. We've had a poor return in 2022, which is really, and in recent months, but we don't know when it's going to get massively out of sync on the positive side again. And the danger is that you chop and change too much, either different systems or your particular system, you start changing it and meddling with it, that it doesn't get into sync when the next market, when it really would have been outperforming, it doesn't now, because the changes you've made make it worse in that environment again. So we don't know what those periods are going to be, and anything can happen in the market, as you know, and we got to go along with it and stick and trust to our existing system. Sure, we can change it, we can research it, and we can work on the process, but on the basis of doing deep-seated research, not knee-jerk reacting in the short term to some emotional thing that you have discomfort with, which is really what really drives us. We get uncomfortable and we want to move. What we got to do is learn how to become comfortable being uncomfortable, and not let that environment make us make mistakes, force us to make mistakes, because psychologically we're not in tune with the environment in which we're trading or operating in. So 3 areas of research just to mention here. Timing, we will be working on some timing, but not to go and reanalyze and reoptimize all the parameters. I'm going to do some research, and AMS have started doing some research on, we've got the stock filter turned on at the moment on ASX and off on the US, as to in secular bull market environments or bull market environments. And this is where the index I mentioned, you may come into it as well, as to when we do and don't use the stock filter. I'll go and look and research whether we should have the ASX stock filter on at the moment in this kind of environment. So that's not imminent, not going to release that next week or tomorrow, but it's being worked on. The other level, which I did mention you and showed you that one chart, is the is a unique SPA3 index. We've done quite a lot on this already and building it, and now we've got to look how we maintain that, and also how we use it from a systematic risk perspective. So systematic risk, effectively market risk, but it's systematic risk with respect to the system, the particular system that we're trading. So that is an area that we're doing research on. So we call that, so we've got timing, risk management, and money management are the three main areas of components that make up a system, a mechanical system. And in money management, we're looking at pyramiding open profitable trades and working on a technical analysis call to action as to when you do that and which trades you do it in and which trades you don't do it in. Can't do that on a discretionary basis. So we're looking at building that in and mechanizing it as well. Quite a tough project, that one. And the other one is, once we have systematic risk, if an index does help, and it does help a systematic risk, market risk, portfolio level risk, if you like, as to whether we could implement a small leverage into what we have now trading as an unleveraged portfolio. Why would we do that? Well, Warren Buffett does it. There's been papers written on that, and I've presented on that in the past in his portfolio. He doesn't see it as leveraged or unleveraged. He just sees it as his portfolio, and at times he will leverage. So why would we do that? Well, if you introduce systematic risk where there's more times that you're going to be in cash, it means that your exposure percent over the life of the portfolio goes down. In SPA3 investor portfolios, that runs in the 80s most of the time. It might creep into the 90s for short periods of time, but overall, if you run a portfolio over many, many years, it's going to be somewhere in the 80s. And if you now start going more into cash because you've got systematic risk overlaid at the portfolio level, it means your exposure goes down, and it might drop into the 70s, even the 60s. So how would we try and get that exposure back up to close to the 80s again? Is that during the times that you are in the market, you make up for that times you're not in the market and you slightly leverage. And the idea would be to get that, you don't want the leverage to go above 100%, but you can edge it back up to the levels that we've got historically in what we've researched, if we're not using systematic risk. So these things all coming together and are combined, and we would, and so they kind of overlap with each other. So we've got to it'll take quite a bit of time to do this, but there are areas that you can see that are not specifically trying to improve the timing of the system. It's researching on the edge with risk and money management. So that's where our focus is going from a research perspective. Right, some recent stumbles. I'll have a look at one of these and just to take you through Market Master on how you can do it. But there've been some lost trades. We haven't had one bigger than 14% in the last many months on any of these portfolios, even the leveraged portfolio. And that's the kind of order of what you will get in with SPA3 Investor. Those are kind of the largest lost trades that you'll have. So let's go and have a look at the evolution mining. So what I do is I go into trades here and I go into close, and you can see that, and I'll just sort this by date close, so the most recent, and just scan through here. You can see a lot of lost trades. There's the evolution mining one. 10, there's a lot of single digit ones over here, but seldom do you get above 14 or 15. This is going back quite some time. You can do that on your own. What I'm going to do is I'm going to open up the evolution mining and see here. This is just the chart. We'll put the SPA3 Investor on so you can see the signals, and you can see down here we've got stock filter on, and that there was a late entry in there. So the 14% loss I think was this one here. Now, what I'm also going to do is I'm going to go to signals and statistics. And I'm not sure how many of you do this, but this is effectively trading evolution mining. And I'll just go to see what period we got here, chart period. And you can see I've got 25 years. So it's got the last 25 years. And you can do all, or you can do parts thereof and set custom as well if you want to. Custom is where I set up the January 2000 to June 2013. And I think you got there the dates are, then you just select custom and you'll get that. But anyway, so now this is trading evolution with the stock filter on, and you can see that the win rate 39, expectancy 0.48. So remember 0.48, maximum drawdown minus 58. But comparing to if you had bought and held evolution, so you would have annualized return 5.62 by trading it with the stock filter on, compared to 6.85% buy and hold annualized return. So what that means is buy and hold, and it works it out. This means if you'd taken all the trades and traded just evolution as a one stock portfolio, excuse me, and it gives you all the other dates over here. So you can see buy and hold risk to reward ratio 13. Yeah, it's 10. That is way too high. But what you can do now is you can go into this is parameters, and you can now just pull this across, and you'll see down here that changes to SPA3 Investor no filters. And what this runs, you can see the signals have changed. And what this does now is it runs through if you traded evolution as a one stock portfolio, but without the ASX stock filter on. So this is no filters. Now, what happens? Win rate goes up, payout ratio, expectancy goes up. Annualized return has now gone from 5.8, I think it was, to 13.43. So straight away, and you can see the risk to reward ratio has gone from 10 down to 6. Remember, that's dividing annualized return by maximum drawdown. Maximum drawdowns got deeper, definitely. That was 58% before. But you could, on these stats, and if you want to go to this level in your for the universe of stocks, you could go through every one of these stocks and you could decide which ones you trade with and without the filter. Evolution is obviously over a sample of 80 trades, which is a big enough sample statistically, is saying it's a better edge without the stock filter. Now, if we go to, for instance, let's go to REA, which is a open stock, which is in the portfolio at the moment. It's an open trade, and this is running it now with no filters. And you will find that there'll be some that are better with filters and some that are better without filters. So with trading with no filters, a better annualized return if you're traded as a portfolio. You got there's a win rate pay expectancy 1.58. The risk to reward ratio 3 versus 4.26. Now let's put a stock filter on. And typically what you would find is stocks that have risen, have had a kind of a bottom left to top right chart over a period of time. And so this one, you can see there's not much difference. There's a much higher win rate. that 29%, 2.24, a little bit lower. Expectancy is higher. So with the stock filter, REA has a slightly better edge. Now, if you had to go to a stock, let's just go and look at, let's go to US. In fact, I'll go to here and we'll look at a stock like, we'll go to one that is Cisco. Okay. Now its price action hasn't yet got back to its highs back at from when it reached it in 2000. And you now go on here and you look at statistics. Now the statistics here is with no filters and 63% win rate, annualized return 9.98 versus 1.79, so much better. You got a risk reward ratio of 3 versus 49, etc., etc. And if you now put on stock filter, so just remember those 63% win rate, so expectancy 1.224 and a risk reward ratio of 3. And so now if you put on the stock filter, it's already, you can see the expectancy is worse, win rate is worse, and so you could then decide so what have we got? Risk reward ratio 5.6, so much better without the stock filter. So these are things that you can do in yourself, and you can actually have some with the filter and some without the filter on. Now, just remember the app you'll have to remember that with the app, but from and you also have to remember that from a scan perspective. So that's personalizing SPA3 Investor for yourself. Now, we obviously don't do that with the public portfolio, but these are the sorts of things that we will do with the research. And rather than making it on-off, we can make it somewhere in between. Right, let's have a look at LEAPS, and then we will finish up. So, excuse me, REA is one we just looked at. CSR, we had a 97% profit trade in that one. That's now delisted. In the US public portfolio, we had 123% in Lam Research and 66% currently open trade in both these portfolios. And NVIDIA, it's 69% profit trade in the leverage, which was closed in March, that particular trade. What I'm going to do is go and have a look at LRCX, and then we will have one more quote to finish. So we're nearly done here, and the LRCX has got a learning lesson in it for us. What is that learning lesson? So let's go to US stocks portfolio. I'll go to trades. I'll go to closed. And if you just scan through the closed trades here from most recent, you'll see there's a lot more green here than what there is in the ASX portfolio. And that is just because the nature of the market has been a more friendly trend following environment in the US market than what it's been in the Australian market. So let's just have a look at Lam Research. Now, Lam Research, I'll just open up the trade here. You'll see that Lam Research, we opened this trade in December of 2022, and the position size we had was $7,000. And that closed in now just last week, 9 days ago. And so that's really a 12, 13 and 7, 20-month trade. And why is that an issue? Well, the issue is, firstly, it was one of the real leaps that we had. But if we go to we go to open, you'll see the position sizes here, capital allocated, are right up at these sorts of levels. Even AXP, which was opened with a $14,000 position, it was double the original position size we had in Lam Research. And why did Lam Research end up with such a small position size? Because we used to have 13 open positions, and the 13 open positions had, at that time in December of 2022, had $8,000 position sizes. And I think LRCX actually had a slightly smaller one even, because there wasn't any capital left as a last trade going into the portfolio, so it had slightly less than what the others were at the time. And then we then changed to 10 positions in the portfolio, and the position sizes went up to $13,000, $14,000 at the time. And how we were left with effectively a half position size in Lam Research, which then went on to be 123% profit trade. And it made, what did it end up with? It ended up with $8,600 profit, and there's really money left on the table of about that amount, 8,600, because the position size was too small. So what should we have done? Now, if we also have a look at the portfolio, and that's the underwater curve, but you can do things like this. If you go into parameters and you click on here, we got a whole bunch of portfolio. We've got a whole bunch of portfolio manager. Anything to do with the this is for looking at equity curves, not for looking at stocks. And we look at number of open trades, just drag it across, and you'll see that here in this period, our exposure was much less because of that moving from, and certainly we were in a down market, but we also had, our exposure was down because we had open positions at the time, because we were trying to get down from 13 to 10 positions, and the position sizing was all out of whack. So that's a money management issue. So what should we have done? Well, what we should have done is try to get our exposure up by the trades that we were in there, that were open trades. We should actually have tried to get some money into those. How much? I can't tell you exactly, but that is certainly a learning from here. We don't want to be running it's particularly in rising markets. Sorry, it wasn't. It was December 2022, which is round about here is when we got. So there's where we went down into those positions that we needed to get more money in the market. Our exposure was down, so we're probably looking at the wrong one. Here's the exposure. No, not exposure. No, that's not the one we're looking for. Sorry, we are looking for making a mess here now. Finger trouble. So this is how you delete panels. We're looking for invested percent. So here's the invested percent during that period of time, and you can see it spent quite a lot of time below 100. And that is, here it is over here. This period of time over here, we were below 100 when we really should have been 100% invested. And that has definitely weighed down on the portfolio. Right, so AXP, you can look at these in your own time. So to finish up, I guess one of the things that people will take from this presentation is the US market has done well. The US leverage has done well in this period of time, more recent time, particularly over the last 20 odd months, nearly 2 years. And whereas the Australian ASX portfolio hasn't. Now, does that negate the edge? Does it say the edge is gone? Well, we don't know. I would argue no, because there are times when we've thought the edge hasn't worked in the past. In our research, you can look at periods where they had negative years. You thought, well, the edge is broken, and it's come back. To me, it's not the edge that's broken. It's the edge matching the market, and it gets in and out of sync. And that's just a natural thing that happens, not only with trend following, it happens with even great discretionary traders using subjectivity, all ways of approaching the market. If you look at what happened in 2008, we had all these hedge funds who had tens and tens of HD people, putting together all these systems, trading short-term, long, short, leveraged, all kinds of instruments. And then what happened in 2008? All strategies correlated to one. All markets correlated to one. Long systems fell, short systems fell, leveraged, all of the asset classes correlated to one. They all went in the same direction. And we had people throwing computers out the window, all sorts of stuff. So a market environment's going to come where whatever it is you're trading is going to be out of sync. So the issue is you're never going to be able to create an analysis environment, a way of analyzing the environment, the market, the environment in which you trade, that's going to be in sync all the time, and that is going to make you comfortable and feel good all the time. It's not going to be achieved through analysis. So how do you achieve it? Well, you got to achieve it by how you think about the market. You have to become comfortable with being uncomfortable. You have to be comfortable with going through periods of immense discomfort and getting through that. And through that, you have to be able to, and there'll be more on this, we'll talk more about this, and about the path to consistency starts with accepting the risks, the risks. And for today's quote, to finish up, comes from Daniel Coyle, who wrote the Talent Code on page 34, where he says, and you can go and read the pages before and after, it's a great read, struggle is not an option. It's a biological requirement. And what he means by that is for us to learn and grow, we have to go through struggle. And the more we run away from struggle and try and solve struggle, the less we will grow. And so we have to go through periods of discomfort. There's just no doubt about it. And there's also, and this is not just me saying it, it's a biological, and this is now being proven through research. And you can listen to podcasts about, we have parts of our brain that unless we go through struggle and get outside of our comfort zone, we get into areas of discomfort, we don't grow. And that's a fixed mindset as opposed to a growth mindset that Carol Dweck has written about and lectured about. So struggle is not an option. It's a biological requirement. And we have definitely felt that going through the ASX and the ASX, the SPA 3 investor. And I'm sure there'll be tons of other trend following strategies that have suffered the same. And is it going to last like this forever? Well, if we take this as a trying to prove the future, as what people do, is that because this has happened, therefore it's going to continue happening. That just does not work, because we do not know what's going to happen, and nor do we need to know. And of course, anything can happen. So I'll finish it there. This is the first one of these. I won't do the setup stuff next time, so it'll be a little bit shorter, but we're going to track these real world portfolios as they go through the ebbs and flows and the thick and thin, and look forward to bringing you that in coming months. So we'll finish there. There are questions. No, I'm looking at the chat here. All good. And of course, questions don't have to be asked in these sessions. You can ask them on the forum, and we can go through it there. So hopefully this has hit the mark with you today, and we'll be back next week where Dave will be taking you through a session. Until then, I wish you consistent, objective, and peaceful investing.